Hey, this is Yosef, a small investment firm that specializes in REIT investing. And in today's video, I'm gonna share my take on the recent fight between Elon Musk and President Trump and how this could impact the economy, the broader financial market, and even the REIT sector. And I'm sure some of you here might be thinking that it's a stretch to think that this would have any impact on the economy, let alone the REIT sector. But I would disagree. I think that this could have fairly significant implications. And the reason why is because this is going to lead to a growing divide within the GOP. Now, on one hand, you're going to have Elon Musk, who would like to cut down on government spending to bring back the deficit under control. He's saying that President Trump's big, beautiful bill will run the country into bankruptcy. And he's also saying that already in the near term, in the second half of the year, President Trump's stupid tariffs could run us into a recession. So that's one camp. And then on the other camp, you have President Trump, who would like to cut down on taxes, which are of course the main source of revenue for the government, all while increasing government spending to boost GDP growth. And this is quite interesting because during the election year, he was of course calling for much lower government spending to bring back the deficit under control. And now it seems that he's completely flipped his narrative, and he's much less worried suddenly about the deficit and government spending, as his big beautiful bill plans to significantly increase the debt ceiling by several trillions just over the next few years. And so now members of the GDP are going to have to pick a camp. Do they align with President Trump? Do they remain loyal to him? Or do they start perhaps pushing back a bit on his ideas and align more with Elon Musk, who still today is a very influential figure, especially within the GOP? And so already now we're starting to see the divide happen, with increasingly many Republican senators aligned a bit more with Elon Musk and pushing back on Trump. And ultimately, I think that this is going to lead to a policy gridlock, a lack of unified economic policy, and much more uncertainty when it comes to deregulation, government spending, tax policy, and many other things. And as you know, the economy hates uncertainty, whether it's businesses, investors, or consumers. Whenever there is uncertainty, they all scale back, and it leads to a slowdown in economic activity. On talking first about businesses, if there's uncertainty, you perhaps are going to delay major investment projects. You're going to be more conservative. You're going to freeze new hirings. At the same time, investors perhaps may raise more cash. They may favor more fixed income investments rather than more aggressive equity investments. And as the fears of a recession grow, then consumers also cut down on spending. They decide to delay major investments like the purchase of a home. And all of these leads to a slowdown in economic activity. And unfortunately, it doesn't end there. There's another unfortunate consequence, and it's that the rest of the world is slowly losing faith in the United States and its leadership. And this is not just because of the drama, the chaos that's happening, the extreme uncertainty, but also because this big, beautiful bill has a section that could potentially lead to a significant tax hike on foreign investors who are buying equities, fixed income, treasuries in the United States. I think it's called Section 899, and it could significantly increase taxes on these foreign investors. And so that's problematic, given that about 20% of US stocks are owned by foreigners. If now suddenly they fear that they could face significant tax hikes, perhaps the demand for US stocks from these foreign investors is going to go down. That then leads to lower share prices for American companies, lower equity multiples, higher cost of equity. This then slows down their growth as their cost of capital goes up. And then this could further then weaken their market sentiment. So that is bad news for the US economy. At the same time, these foreign investors are critical to finance the US deficit. And there's a bit of an inconsistent here in the policy, because on one hand, the big beautiful bill plans to significantly boost deficit spending, which requires foreign investors to finance the debt. But at the same time, you're alienating these foreign investors who today possess about 30% of the treasury. So it's a bit weird. I cannot really make sense of it. But ultimately, this reaffirms my thoughts that I think that the economy is likely going to face a recession in the near term. I recently posted a detailed analysis on why I expect a recession. I listed 5 main reasons, and you can read this analysis for free at High Yield Landlord. This is my REIT newsletter. It will be the first link in the description. I've temporarily removed the paywall, so if you see this video now and you click on that link, you'll be able to access the full analysis. Make sure to also sign up for the free tier. We publish 1 free article there every week, typically highlighting highlighting some of our favorite REIT investment opportunities. But so in short, I think that there's too much uncertainty today, and I think that ultimately this chaos is going to lead to a recession because businesses, investors, and consumers hate uncertainty and slows down economic activity. Before we had a lot of uncertainty on trade policy, but now we also have growing uncertainty on so many other things, including deregulation, tax policy, even especially for foreign investors, government spending, and so on. And by the way, I'm not alone to think so. JP Morgan has said that right now the risk of a recession is basically a coin flip away. They think that the risk of a recession this year is about 50%, and the odds rise further the more out you go. So in 2026, the rise will be even higher. The risk will be even higher, sorry. It's not even me and JP Morgan, it's also then just look at the debt market. The Fed Watch tool is today predicting 4 rate cuts within the next year. And the reason why it's predicting so many rate cuts is because the debt market fears that we're going into a recession. I mean, if it didn't fear that, it wouldn't be predicting so many rate cuts. And so with this in mind, what are the best investments for today's environment? Again, so today's environment is relatively weak growth, likely weakening, significant uncertainty, uncertain inflation as well, but likely significant rate cuts in the near term. And I'm of course biased in saying this because I'm a REIT analyst, but I think that REITs are the winners in this environment. And that's because a lot of REITs are recession resistant given that they own essential infrastructure that's leased on a multi-year basis. I mean, just think of cell towers, affordable housing, manufactured housing, data centers, grocery stores, e-commerce warehouses, farmland, net lease properties, hospitals, senior housing. A lot of these property sectors are really not impacted by recessions, or only very slightly, especially since they have long-term leases and their demand is not cyclical. But despite owning these recession-resistant assets that throw a lot of cash flow, REITs are today very heavily discounted, trading at the decade-low valuations due to the surge in interest rates that we experienced in the recent years. The Fed already started cutting interest rates in late 2023, and it has already led to a 30% surge in REIT share prices on average. However, valuations even then still remain really low, and I think that this recovery is set to now continue as interest rates are cut down further over the next 12 months. And so we can highlight a few examples here. One that I bought quite recently is called Kite Realty Group, ticker symbol KRG. This is a retail REIT that owns mostly grocery-anchored, service-oriented strip centers in rapidly growing Sunbelt markets. And so this is a very resilient, recession-resistant asset class. The REIT has enjoyed some of the fastest growth in its property sector over the last few years because its rent levels are deeply below market, because it has long-term leases and the contractual rent escalations in the leases have been below market average. The market rents have grown even faster, and so this is giving it now an opportunity to bump up its rents as leases gradually expire. On top of that, it has one of the strongest balance sheets in its peer group with very low levels of leverage. But despite that, it's today trading at just 11 times FFO, which is one of the lowest valuation multiples in this property group. Again, despite having the least leverage and some of the fastest organic growth, which is quite interesting, and an estimated 25% discount to our estimate of its net asset value. And so as now interest rates are cut and more capital flows into the REIT sector, I think that this is a type of REIT that could enjoy quite significant upside, as it now reprices at closer to 15 times FFO, where most of its peers have historically traded at during most times. It would result in about 40% upside from here. And while you wait, you're earning a 5% dividend yield that's very safely covered and still leaving the REIT a lot of retained cash flow to keep reinvesting in growth at the same time. So I think that even ignoring any upside from the valuation multiple, the REIT should be set to deliver roughly double-digit total returns from its yield and its growth. But on top of that, you have fairly significant upside from the catalyst of interest rates being cut. Another interesting example that comes to my mind, I didn't even mention this property sector earlier, but it's that of cannabis cultivation facilities. Typically when we go into a recession, people will consume more alcohol, more cannabis, any type of vices, typically quite resilient recessions, and alcohol and cannabis especially so because people are stressed out, they're looking for relatively cheap escape, and so There are a few cannabis REITs that could be quite interesting today. One of them that I own is called New Lake Capital Partners. It owns cannabis cultivation facilities that it leases on a triple net basis on a long term. Its average remaining lease term is over 10 years. They include nearly 3% annual rent escalations. The tenants are responsible for all property expenses, including even the maintenance, the insurance, property taxes, and so on. So it results in very consistent and predictable cash flow for the REIT. And what's unique about New Lake Capital Partners is that it has zero debt on its balance sheet. In fact, it's significantly net cash positive. This significantly reduces risks, of course, but it also gives the REIT some optionality to boost its growth rate in the future, because at any time it could take on new debt to acquire new properties and create value for shareholders. But despite that, it's priced at a very low multiple. Today it's trading at just around 6.5 times FFO. It's offering a 12% dividend yield that's safely covered. In fact, its payout ratio today is at the bottom of its targeted range of 80 to 90%. I quite recently talked to its CEO, and he seemed to imply that another hike might be coming soon. This REIT has actually hiked its dividend many times since going public. I mean, it has done so every year, sometimes a few times each year. By the way, if you want to read our exclusive interview with the CEO of New Lake Capital Partners, this one is behind a paywall, but you can join us for a 2-week free trial at Landlord. You can sign up using the second link in the description of this video. You won't be charged anything in the first 14 days, so you can just join, read the interview, review our REIT portfolio and all our other research. If you don't see value in the service, you can cancel within the first 14 days. You won't be charged a penny, no questions asked. But yeah, again, in short, I think that the unfortunate reality is that this recent battle with Elon Musk, the world's richest person and one of the most influential person on this world, and Donald Trump, who's the world's most powerful man, is likely to have fairly severe consequences to the economy, the broader financial market, and even the REIT sector. I also think that this recent fight that we saw is unlikely to de-escalate anytime soon. Right now I'm seeing some news articles that perhaps one will say sorry to the other and they'll get back together, but I have a hard time seeing that happen, because once you have one party call the other one a pedophile in such a public way, it's very hard to it's really hard to get back together and make peace. But the silver lining in all of this is that this uncertainty is likely to weaken the economy, and while this is bad news for most sectors of the economy and perhaps most stocks, businesses, I actually think that in this case bad news turns into good news for REITs, because they are trading based on the level of interest rates today. And if we go into a recession and interest rates are cut down significantly, this is going to be a very significant catalyst for the REIT sector. Put differently, I think that the positive effect of rate cuts is going to be stronger than the negative effect of a weakening economy, ultimately leading to higher REIT valuations. And for this reason, I haven't changed my strategy. I keep buying more REITs week after week, gradually. I cannot time the market. I don't know when this recovery will take place, but we keep gradually week after week making small additions to our portfolio. That's all I had for you today. Please consider clicking the like button if you enjoyed this analysis. Subscribe to the channel. I really appreciate it. See you at my next one. Bye-bye.